Good afternoon, all. Thanks very much for joining us on what is turning out to be quite a nice spring afternoon. My name is Avinash Kalkapersad. I head up the research division or the markets research division for Nedbank. And for those of you that haven't joined in before on one of these fireside chats, I hope all of you have at least joined into one previously. This is basically a run through of each of the sectors, each of the asset classes that we as a markets team cover. So today the sector that we're going through is retail, and it's probably a sector that a lot of you out there know quite personally. So everyone has a story about which shop is the best and which experience is the best for them. And we're hoping that Sa'ad is going to shed some light on his preferences within the sector. Just to give you a bit of background, Sa'ad has been with us at Nedbank for just over a year now. He's a chartered accountant by training, and he's responsible for the retail sector as a whole. He has covered the sector for a number of years prior to joining Nedbank and is really a wealth of knowledge in it. Just a bit of admin before we get into it. A disclaimer that this is all public side. We sit on the public side, so we don't have any information that's material non-public. And another thing, don't stress too much if you have to jump in and out of the call. We do have a recording that will be available for you guys post the call. If you have any questions, please feel free to pop these through in the meeting. There should be a box somewhere on your screen that you can click on where you can pose questions that we'll try to answer. So the structure of today, we've got 45 minutes. We'll go through a few major themes. There's probably 3 or 4 that we want to touch on today, and then we'll leave a bit of time at the back end to go through some of the questions that we've got through the audience. So without further ado, I think I'm going to kick it off just with a sort of opening point, Sa'ad, for those that don't look at the sector and don't look at markets in massive amounts of detail. Just give us an indication of what is retail, what do you cover?
So good afternoon, Avinash, and thank you for the opportunity, and good afternoon to the listeners. So retail, we all know, it's obviously the sale of products to the customer. In South Africa, we look at, split up into sort of 3 different buckets. You have your clothing retailers, you have your discretionary durable retailers, and you have your food retailers. So under the clothing space, it's most of the big names that most people are familiar with. It's Woolworths, Mr. Price, Foschini, Truworths. Under the discretionary names, it's Massmart, there's Lewis, there's Cashbuild as well. And then on the food space, it's Shoprite, Pick n Pay, Spar. And so basically that is the sector that we look at, and that constitutes majority of your SA retailers. You do on the listed side. There are unlisted players as well in the sector that aren't listed, but in South Africa, majority of the market share in South African retail is on the listed side.
Thanks for that overview, Sa'ad. I think it's quite a broad range of companies that are obviously under your coverage. And as South Africans, I think the retail sector is obviously fundamentally important. If you look at our GDP numbers, we are a consumer-driven economy. So I think your insights are really going to be helpful in determining where we are as South Africa and potentially what the outlook is going to be. So let's just kick off initially with your overall performance of the retail sector. How have the retailers been doing maybe this year?
Yeah, so this year it's obviously been, COVID has really impacted the retail sector, and from a consumption perspective has sort of played a big role in the performance over the last 6 months. There has been 2 diverging trends that we've seen that come out between the clothing sector and the food sector, and within the clothing there's also been some diverging trends. If you look at the clothing sector in detail first, we've seen a strong performance by your sort of cash, value, and basic retailers, as well as retailers exposed to kids and basic wear. Whereas the guys have really underperformed are your mid-market fashion retailers and your credit retailers. So on the whole, it's been Mr. Price, Pepco, Pick n Pay clothing outperforming, whereas Woolworths clothing has really underperformed, being the laggard over the last few months. In the food space, we've seen a very strong growth coming from most of the food retailers, especially Woolies Food, growing around 15%. That's the outperformer there. And that's just been driven by a shift in consumption spending from most of your middle to upper LSM income customers, from eating out to eating in. And I think that trend is going to continue for a while, although it might slow going into next year. But I do think that there is going to be some support for a lot of their food retailers in this environment.
That's a lot of meaty topics that you've brought up there, Sa'ad. Thanks for the overview, and I think we'll get into a bit more detail on some of them. But just chat about the economy quickly. I mean, as South Africans, we sort of know that the economy has been in a tough spot and is probably going to be in a tough spot for a few years to come. What are the sort of key things that you look at from an economic perspective that drive your retail sector?
So the drivers of the sector is generally job creation, household disposable income growth, consumer confidence, and obviously interest rates and the rand dollar. On the whole, except from interest rates, most of these metrics are pointing to a very dire consumer. We know recently that there were 2 million jobs that were lost in Q2, and we think that there will be further retrenchments across the board, across different sectors in Q4 and going into Q1 next year, which obviously puts pressure on the retail sector, especially your discretionary retailers. We do think that your higher income customers obviously are in a better financial position to actually withstand this and to navigate the crisis compared to lower income customers. And that's why I think companies should actually be more exposed, or sort of target or reposition their business model to be more exposed to middle and upper income customers who are resilient. We do think that over the next sort of 5 to 10 years, the gap between your wealthier and sort of lower income customers is going to widen, and your higher income customers will be able to absorb pricing increases and support volume growth over the next sort of in the short to medium term.
Let's maybe just touch on that first, or the only sort of positive that you mentioned from an economic perspective there, the lower interest rates. We've had steep cuts in interest rates. Has that fed through to the consumer, and what's your expectation on how the consumer behaves in this environment going forward?
Yeah, I think from the cutting of interest rates is mostly due to is a more defensive mechanism, just to help consumers have that extra rands in their pocket to continue buying. We haven't really seen a big uplift as a result of that, because a lot of your credit retailers have been tightening their credit books, and that's just because of risk of impairments and bad debts coming through. But I think if interest rates stay lower for longer, which they most likely will be doing over the next sort of 12 months or so, I do think that as consumers come out of this and as the economy reopens, businesses start doing better, people start earning salaries again, the guys who are sort of in a sort of better financial position could take advantage of interest rates, so maybe spend more on credit cards and overdrafts, and I think that should come through in sort of Q1 to Q2 next year.
Yeah, I suppose that's one beacon of hope that we have in this environment, that the lower interest rates will sort of feed through to better spending. So just on how we as South Africa compare to sort of the other markets that you look at from a retail perspective. Obviously, South Africa's had a long lockdown and probably one of the earliest to go into restrictions. How are the retailers managed in this environment?
Yeah, so if you look at global markets, of the overall retail sales for South Africa is still negative, coming out of lockdown from May till about August, while other countries have started returning to positive retail sales growth since July. So we're still lagging. If you look at clothing retail sales, I think, sorry, just to go one point back, is the reason why we're lagging is obviously because of the strict lockdowns across tobacco and liquor and certain other sectors. And if we just move to clothing retailers, I think that's where South Africa is outperforming the rest of the world. We've started seeing sort of 0 to -5% clothing retail sales growth across the sector, whereas many developed markets, China, the US, Australia, and UK, are seeing sort of negative sales growth of between sort of 20 and 30%. And a lot of that has been driven by the shift to online. So in South Africa, our online sort of is still immature, and theirs is obviously a lot more mature. And a lot of that spend has moved to online. So whereas your brick and mortar stores are still suffering. On the food space, I mean, we're still in line with the rest of the world. I mean, most of globally, the average has been around 10%. In South Africa, if you look at the retail sales coming out of the retailers, the food retailers, is around 10 to 15%. So we're in line there.
So you touched on the sort of brick and mortar entities or the ways of selling retail. What's your overall view on what happens there? I mean, we've obviously seen a big shift to online internationally. Is there still space for brick and mortar offerings?
Yeah, definitely. I think the international average of online versus brick and mortar is generally on mid-teens, and it's probably gone up to about 20% now. So that means there's still 80% of sales that are done in store. In South Africa, we sort of 1 to 3%, moving now to between 5 and 10%. It'll probably end up around 10%. I think the logistics piece, is a bit of a challenge for a lot of retailers in South Africa, but they are pushing the click and collect model. I think a lot of retailers have had to relook at their strategies, and they're investing quite a lot in the e-commerce space. But I still think brick and mortar does still play a big role in the South African retail market. So I don't think it's going away anytime soon. I still think we'll have 80 to 90% of brick and mortar sales, especially if you look at middle to lower end shopping malls. They'll definitely keep doing well. The high-end shopping malls they'll probably see a reduced foot traffic because of those consumers shopping online. But I do think once normalized behavior returns, I think people will start going back to shopping malls again. It's the whole retail therapy and whole retail experience which most consumers need.
And you touched on the lower end consumer there, Sa'ad, and probably penetration rates are a little bit lower in terms of online sales. What are some of the other drivers that ensure that South Africa is probably going to be less than international peers when it comes to e-commerce penetration?
So I think for us, I think it's the logistics challenges. It's going to play a big role in South Africa. I think it's security and customers. We got a lot of shopping malls in the country as well, and I think that the cost of delivery to the customer is obviously dilutive to margins for most of the retailers. So I think they're cognizant of that, and they'll just have to find ways to get the consumer to actually come pick up the product from their stores to reduce that cost of delivery for the retailers. And I think that's the biggest challenge, and also the geographical spread of the South African sort of more affluent suburbs and the middle income suburbs, where it could be costly for a lot of these companies. Whereas if you look at Europe, where online penetration is in the 30s and going into the 40s now, everything is very densely populated, and it's a lot easier for the online players to penetrate those customers over there.
And so just remind us of the numbers again. So I think you did mention the penetration rates currently in South Africa, and then where do you expect them to go in, or where do you think they are at the moment, and where do you think they'll go in 5 years?
So we're around 1 to 3% of total sales in South Africa. We think post-COVID, sitting around 5%, and we think it could easily get to about 10% over the next sort of 3 to 5 years. Then there's a big drive by consumers to start shopping online, and definitely up to about 10% as more people start buying online. I do think that the manner in which it is rolled out might be different. So a lot of online purchases from computers and cell phones, but with the delivery end of it might differ to other countries, and that's where I say again it's more about pushing the dark stores, click and collect models, and those type of things, where the logistics side is a lot cheaper for the retailer.
And maybe just to touch on specifics, Sa'ad. So if we do find this trend moves from 1 to 3 to 5 to 10%. Is that good for the retail sector, firstly? So that's first question. And then second question, which of the companies under your coverage would probably benefit the most from that?
Yes, I think that definitely it will be good for the sector. I think overall growth and overall spending and consumption in the retail sector is always good, in any which way it comes, and definitely top line growth is definitely positive for the sector. And the companies that I think will obviously do well, on the food side, we've seen Checkers do exceptionally well. I think on the whole, they're all sort of equal platforms in terms of operations. Checkers have sort of, their timing was excellent with their 60/60. I think they've done really well. I think Woolies Food has an opportunity to grow there. I think they have been a bit slow when it comes to their turnaround online, as well as on their clothing side. But I do think on the clothing side, Mr. Price and Foschini are probably best placed to benefit from online and have the best sort of rolling out of online strategies in South Africa on the clothing and discretionary side.
And you mentioned 60/60. That's obviously Checkers' own platform. Do you think that your own platform is the way to go, or do you think that the likes of a Take-A-Lot, Mr. Delivery, etc., can fit into this environment?
I think, yeah, so definitely your own platform. I think you don't want to give away any market share or you don't want to be paying someone else to run what you can do. I think the retailers do actually have to really look at their online strategies and just really look at how to actually efficiently run it, especially from a warehousing, from a store perspective, getting closer to the customer and logistics. But I do think it's important for them to own that and then give it away to someone else. The logistics side of things, that's up for debate. I think that could be run by, there are retailers who use DHL and Fastware and the like to actually run that for them. But at the end of the day, it's obviously the economics of it have to make sense, where it's not really dilutive to operating margins.
Yeah, and I suppose that's key. I think a lot of companies have done pretty well, and South African returns have been pretty high for a long time, and this disruption has come now and really forced companies to look at doing things differently. I think just to park e-commerce there for a little bit, I'm sure we'll get a few questions on it later, but just to move on to COVID and the restrictions. What have you seen in the retail space on the back of the restrictions?
So we've seen we've seen a lot of changes in business models and business models starting to use COVID as an opportunity to cut costs and relook at their business. And obviously, e-commerce is one big area where a lot of companies are now reallocating capital to, compared to brick and mortars and reopening of stores. You're also looking at the product ranges. So if I give an example, in the clothing space, there's a big move to value, a big move to basic wear. And I think really looking at what products you have, does it resonate with the customer now in a COVID-19 world, or does it not? What can you introduce and what can you get rid of? And also looking at pricing, I think pricing is a big sort of factor of spending for consumers going forward. I think there are going to be price wars, and selling price inflation is likely to be as low as possible by the retailers. They're going to look for ways to keep volumes and keep market share. I think that's what's going to grow. I think, and that's going to be driven by obviously changing your product mix and then sourcing efficiently to actually lower input prices and in turn lower selling prices for the customer. And space optimization is the other one, where a lot of retailers are really looking at their space to say exactly which product ranges are underperforming and which brands are underperforming and which brands you can actually exit, actually get rid of. And then lastly, if you look at the operating metrics and the financial metrics of a lot of the retailers have been under pressure. I think from a balance sheet perspective, they're using this opportunity to cut dividends, cut capex, and refocus on balance sheet and paying down debt to just put them into a better position to, when coming out of COVID, to either execute acquisitions or just improve sales densities, operating margins, and return metrics.
I think you touched on space optimization there, Sa'ad, and I think for the net bankers on the call, or a lot of net bankers on the call, property is quite close to our hearts, also to our balance sheets. How have the rental negotiations gone with the retailers?
Yes, yeah, the rental negotiations have actually gone pretty well. I think it was just for the month of April where they paid about 20% of the rent. On the whole, what we've been seeing is, around 50 to 100 million rand concessions that have come through sort of for the retailers. It is 55 million for Woolworths, about 80 million for Truworths. So that is sort of one-off, concessions. But as trading has resumed, as stores have been opened, as foot traffic has increased, I think they're starting to get back to sort of 100% payments. And then, the big factor is going forward is, how retailers look at rental escalations and reversions on leases that are coming up for renewals. I think it's important for the retailers to actually keep that relationship with the landlord cordial and not be too aggressive, because if things change, the landlords can be difficult as well. So I think that relationship is a very sensitive and delicate, that both parties need to sort of play ball in these type of environments.
I suppose your ability to play ball is kind of dependent on how important you are to the property company. Is that a trend that you've seen where some of the bigger companies or the bigger listed guys are doing better than some of the smaller independent players?
Yes, definitely. I think that obviously the bigger you are, the more muscle you have, the more balance sheet you have, the more negotiating power you have with banks to actually lend you money. And definitely with the landlords, you have more negotiating power. I think Foschini, Pepco, they've got the most number of leases in the sector, and they're definitely using that muscle to negotiate with landlords. And I think Foschini is getting stronger now with their sort of 380 store acquisition of Jet. And I think that's the important thing is, for a lot of these businesses, it's, on the whole, it might not necessarily mean an actual reduction in your total square meterage. It's actually sometimes you're cutting back on unprofitable brands in your portfolio, and you're closing those, but you're reopening sort of value-creating brands, or brands that can gain market share. And I think Foschini is a good example where they've started opening sort of value-end brands, but cutting back on space in their sort of Markhams and Foschini brands, because obviously that's sort of mid-market and sort of losing market share in this space. So I think it's important to look at the dynamics of which brands are performing better, and which and where you're aimed at, and which sort of the consumer that you want to target is most important in this environment.
And maybe if we carry on that topic, Sa'ad, and let's go to food retail first. Just under your coverage, what segment of the market do each of the companies try play in, and where are they strong?
So if you look at the top down, Woolies Food is obviously aimed to your middle and upper LSM customer. Then you've got sort of Pick n Pay and Checkers, which is your mid-tier, middle to upper. And then you've got sort of ShopRite, Usave, Boxer, which is also towards your bottom end of the market. Spar is sort of in the middle to upper, and neighborhood convenience stores. Yeah, so on the whole, sort of that's the way the value chain sits for the food retail sector.
And if you go through the performances of each of those companies over the past 6 months, maybe 6 to 9 months, which of those segments has performed well?
Yeah, so definitely your higher LSM exposed retailers are much more resilient. and seeing a lot better growth than your lower end. And this is pre-COVID and post-COVID. We've seen growth of your Checkers brands and Woolies food brands of around sort of 10 to 15%. And that's contrasted with the underperformance of ShopRite and USAID brands, which of around 5%. So there's a very, very big disparity between, which consumer segment is more resilient and doing better, and the ability to absorb pricing increases. So to give an example, Woolies pricing increases recently is about 6 to 7%, and it appears that their customer can definitely absorb that 6% increase. Whereas I don't think that a ShopRite or USAID or Pick n Pay's Boxer can put through anything around 5% or more price increase, because obviously their customers are much more sensitive to any price movements.
I suppose touching on Woolies a little bit, I mean, one of the things that they've done fantastically over the past decade or so is really improve and increase their private label brand. And that's something that you've written about quite extensively in the past. Maybe just give us some insight into what you're thinking about the private label market.
Yeah, so the private label is definitely a growing area for the grocery retail market in South Africa. Woolies Food actually pioneered it in the early 90s. They're sitting at around 80 to 90% private label contribution to sales in their businesses. The rest of the South African retailers are around 20 to 25%. Global average is around sort of 16 to 20%. And global and your developed markets, European markets, are sitting at around 30 to 40%. In South Africa, 20 to 25%. We think we could get to around 30%. The big driver of this in the recent years is obviously pricing. It's a lot cheaper. It's about 15 to 20% cheaper than branded items. There's been strong investment into the strategies of private label, and there's a lot more science that's going into private label now by the retailers. There's tiered approaches that have been used by Pick n Pay, by ShopRite, in executing their private label strategies. And then obviously the quality of the product and the presentation of the product and positioning of the product in the stores has really improved. And nowadays many customers can't even taste the difference between the two. So on the whole, there's a lot of emphasis being driven in private label. And then lastly, for the retailer, it's higher gross margin for them, which obviously benefits them from an earnings perspective. So I think the customer, it's the price, and the retailer, it's the margin, and I think it's working very well at the moment for everybody.
Sa'ad, you mentioned a little bit earlier about some of the changes in consumer spending patterns that we've seen. So obviously we had takeaways and restaurants shut for a pretty long time. I would expect that food retail benefited from this trend, but is this something that you think will continue?
Yes, I think definitely we saw growth of very strong growth. A very strong shift in demand just during and post lockdown, and that is obviously pent up demand and closure of restaurants. I do think that out of we estimate it's around about 6 to 10 billion rands of shift in spending from sort of restaurants into the food retail sector from sort of May onwards, and I think a lot of that will stick, but there'll be a slow it'll dissipate slowly over the next sort of 12 to 18 months once consumer behavior sort of normalizes. But I do think that for the remainder of this calendar year and going into the first half of next year, you will see a lot of that sort of 6 to 10 billion rands of spending still remain, but albeit some of it does slow. And some of it does dissipate as the months go on, and as as restaurants start opening and people start sort of traveling as well and going on holiday and those type of things.
Maybe just to shift a little bit to the apparel retail sector. How defensive has that sector been, and how has it performed?
Yeah, so Yeah, so the apparel retail space is, it's been a very interesting space over the last sort of few years. It has underperformed, and there has been sort of a lot of market share changes, and the dynamics around market share has sort of changed quite a bit. We've had, the big uh, elephant in the room was Edcon, and then what happens there. We've now seen what's happening there. There's a lot of market share being given up. And then there's also been the big move, over the last 10 years or so down to the value segment. So the value segment was around 50% market share about 10 years ago, and now it's about 60-odd% market share. And that's obviously played into the hands of, the likes of Mr. Price, Pepco, Pick and Pay Clothing, as well as a bit of the TFG brands who have won in that space. The guys who've lost has been your mid-market credit players, which is mainly Truworths, Woolworths, and some of the Foschini brands. So that dynamic was driven by, retailers becoming a lot more sort of price competitive, consumer income, disposable income, slowing, and unemployment increasing. So, and people becoming a lot more sort of cost conscious. And I think given where the economy is at the moment, you're going to see that trend continuing quite aggressively. And I think that's, why a lot of the retailers in South Africa that we've spoken to recently are saying that they are changing business models and product ranges and product mix to tailor more for your value customer and the basics products as well.
So just in that space as well, if you sort of rewind a few years, we had quite an influx of international companies coming into South Africa, the likes of Zara, H&M, etc. Has the current economic environment changed the ability of those internationals and the willingness of those internationals to be in South Africa?
Yes, I think that they came in with a bang from about 2010, 2012. They opened up aggressively, and you had Cotton On, you had H&M, Zara, and I think a lot of that, aggressive space growth has slowed somewhat. If you look at the underlying performance of some of these businesses, and H&M is an example, they, apart from space, their like-for-like growths are pretty flat, or if not negative. So, they haven't really been shooting the lights out. And I think the consumer environment is tough. They did sort of overestimate, the demand in South Africa. And the only way they could grow now is, by taking market share from, the market share that's been given up by Edgar's and Jet, and opening up in sort of outlying areas and smaller towns and the like. But on the whole, I don't see any big expansionary drives and aggressive drives by international retailers. I just think that if you're sitting as a CEO of an international retailer in Europe or the US or Asia, there are much better or other sort of faster growing, economically growing countries that one could invest in Eastern Europe or Southeast Asia, where you could get better growth and obviously, better translation of the currency. I think with the rand appreciating the way it is in dollar terms and euro terms, your returns, your SA rand returns are being wiped out. So I think they're also looking at it from that perspective, and that's why you see sort of that expansionary drive that has slowed somewhat in the last few years.
So just tying in sort of COVID and this working from home vibe to the retailers. I mean, I've just realized that this is the first time I've put on a formal shirt in a while, and you have to go out and dig it out the cupboard. But is that something the international retailers, the South African retailers are thinking about, that people's clothing preferences might change forever?
Yes, definitely. I think all the South African retailers I've spoken to over the last month or so have mentioned that they need to have basic wear in their product ranges and reduce the fashion element and formal wear. And I think that is going to be a big drive. I think over the lockdown, most consumers would know H&M sort of perfected it pretty well in the big malls like Sandton and Rosebank, where they had quite a very competitively priced basic wear, and athleisure wear is the big theme as well at the moment for most consumers sitting at home. And I think that's, you remember, if retailers move that way, you're changing your product mix, your pricing points come down, and your price inflation also comes down because obviously a basic item is a lot cheaper than a fashionable product. So I think overall it helps the costing and the price inflation for a lot of these retailers as well. So I think we're going to see a big move over towards that. And I don't think many sort of workers or guys working from home are going to move back into the office very soon, I think. And if they do, it's going to be more sort of flexible hours.
That's a very interesting structural change that most of us think would have happened this year, but to hear the corporates talking about it and putting into their strategic plan sort of makes it a bit more real. I think we've got about 10 minutes left, so I'm just going to jump into some of the questions that we've got from the audience. The first one is just, could you please touch on the credit market, so the difference between how cash sales have done versus credit sales?
Yeah, so obviously cash sales is generally outperforms credit in this environment. What's been happening is your credit retailers have tightened up the lending and tightened up the books, and when they tighten that up, there's obviously they become more stricter, so there's less credit, and less credit being given and less credit sales. So we've seen, Truworths who reported now for July and August, their credit sales was down 14% versus cash sales was down around 5 to 10%. So on the whole, credit has been underperforming. The big problem with credit going forward is that when you're tightening up, you've got to start providing, and then obviously you've got the risk of bad debts. So the mix is, if you've got cash sales, what a company like Foschini has, about 60% of cash sales, you can tighten up as much as you want because you know that your customer can buy on cash and you've got a big cash element. So it's fine that you're tightening up, and even if you're sort of impairing a bit, it is okay because you've got the cash sales coming through. Whereas for a company like Truworths, even if you tighten up, you've only got 30% cash sales. And your pricing points are much higher. So it's a lot tougher then to actually generate sales in this environment. So on the whole, tightening up credit, obviously you're going to start seeing a lot more sort of provisioning for impairments, and then going into next year, sort of higher bad debts as well coming through. So that dynamic between tightening up or being more lenient obviously depends on the quality of the credit customer, which I think is not going to improve in the short to medium term.
Okay. The next question is there a future of big centers in South Africa? So I assume we're talking about big shopping centers here.
Yes, I think definitely. I remember, I think some of the retailers I mentioned before, so the 70 to 80% of your sales come from 20% of your malls, and that's your biggest malls, or 20% of your stores, which is your biggest stores. So I think they're big revenue generators for the retailers, especially from foot traffic and from tourism. I do definitely think that a mall like Sandton City, Waterfront, Mall of Africa, they do rely a lot on tourists coming through as well. So I think once international travel resumes, these foot traffic in these malls will start improving again. And then also, a lot of these malls, it's a retail experience. People want to go out with their families, and it's got everything there. So I think from that perspective, big malls will definitely be, especially your big super regionals, they'll definitely be a place for these malls.
The next few questions are probably tied together, but it's just around market share. So it does look like Shoprite has been gaining a bit of market share. Where has it been coming from?
So Shoprite, you have to split out their business into sort of two parts, which is the Checkers brand and the Shoprite and Usave brand. I would think that Checkers has been gaining some market share at the expense of a little bit of Pick and Pay and a little bit of the obviously shifting from out of home into sort of in-home spending. And then a lot of that has also been driven by new stores. So their growth of around 15-16% is the two biggest stores that opened was Sandton City and Constantia, and that helped that growth. If you look forward, I don't think they're going to be growing so fast. I think they're going to be growing maybe between 5 and 10%, and those two stores added quite a lot. And I do think that they are taking some market share, sort of a little bit from Woolies, but I think Woolies' strategy, Woolies' food strategy is definitely to fight back. They've announced a 750 million rand price investment at lower prices to actually regain some market share and actually continue sort of growing. So I think on the whole, Checkers is the only sort of segment of the Shoprite business that's sort of gaining a little bit of market share. Shoprite and Usave are definitely not gaining market share. I think they're sort of underperforming. I think that end of the cost of the market or the consumer is really suffering, and they have been losing market share to Pick n Pay's Boxer at that end of the market, and your independent cash and carries and your independent retailers as well at that end of the market.
Okay, and another question from the audience here. What is your view of Cotton On in terms of their quality and price competitiveness?
Yeah, so Cotton On is a great business. I think they've done exceptionally well in South Africa, and I just think that they're obviously not as cheap as as a Mr. Price, but obviously the quality is a lot better. And I do think that they're in that position that they could take market share because they are in the basics or athleisure sort of segment of the market, and they're not too fashionable, and they're playing both actually. So I do think that customers sort of trading down or moving laterally, especially with the closures of Edgar's stores in your big super regional and regional malls, will definitely play into the hands of a Cotton On. And I do think that they have the quality, they have the pricing points, and they have the margin, they have the quality, the pricing points, and the products that could actually help them gain market share in this environment.
So I've got a cracker of a last question to leave you with here, and this is obviously the golden question. How quickly will the retail sector recover?
Yes, I think that's obviously the jury's out on that, and probably the toughest question. But I think we did some analysis in our initiation on what happened to the US markets and US retailers post the global financial crisis, and those retailers took about 4 to 6 years to recover. In South Africa, I think because it's so concentrated, especially in the clothing space, I would think that it's a bit shorter. We estimate about 2 to 4 years to recover back to calendar year 19 levels. And I think that's just, in the US, what happened there, a lot of the online players started taking a lot of market share, the likes of Amazon. So I think in South Africa, because our online is not as established, I do think that, our sort of recovery will probably be about 2 to 4 years. So we still have to wait a while. And with that recovery, it's also going to be skewed to certain retailers. So certain retailers might recover faster, while others take a bit longer. And the ones that our sort of preference in the sector is obviously Mr. Price, Foschini, and Woolworths, likely to recover a lot faster than the others.
So I think that's it from us for today. I can't thank you enough for your time and your valuable insights on the retail sector. A rather somber outlook, but I think a rather realistic outlook for the retail sector, and nice to know that there are pockets of opportunity, as you just mentioned. Thanks everyone for joining the call. We hope you found some insight during the call, and we hope you'll join us for the next ones that our team hosts. Thanks very much, everyone. Cheers.